One of the most intuitive ways to price an asset is to compare its value to the price of other similar assets. You do that when you're in the market for a new house, a new car, and even a new TV. How does it function? To buy a new car, you would visit several dealerships, collect information about the characteristics of the vehicles offered, and compare their prices. The key to this process is to evaluate assets that are similar. You can't expect the price of a luxury vehicle would be the same as the price of a regular car, right? But then if you compare similar models of Mercedes, BMW, and Audi, considered as premium brands, you would expect them to have a rather similar price, correct? Let's say that a C-Class Mercedes starts from around $44,600, and an Audi A4 costs $40,995. What do you think will be the best price of BMW's analog BMW 3 Series? Nearly the same, right? That's true. It costs $42,455. Close to the average. So, comparable assets can be of great help when we need to price a given item. This approach applies for company valuation too. If we find companies that are similar in terms of business, industry, size, geographical location, and growth perspectives, then their market valuation can help us determine the price of the firm we are valuing. This approach is called multiples valuation. But how do we apply multiples in practice? And what is a multiple? Let's use a very simple, practical example. Suppose Joan is in the market for a new house. Her real estate broker shows her one property, and she's in love with it. But after the initial excitement, Joan becomes a bit uncertain about the house's price. Is the seller asking too much? Or is this a great deal? To avoid cognitive dissonance, Joan carried out some research and found out that the house next door was sold for $150,000. It has 1,500 square feet. This means that the buyers paid $100 per square foot, correct? $100 per square foot is what we call a multiple. We can use this measure to make a meaningful comparison with the price per square foot of a house that has slightly different size, but fundamentally the same characteristics. So, the property Joan wants to buy is a bit bigger, 2,000 square feet, and costs $200,000, which is exactly $100 per square foot. This reassures Joan that the price she is about to pay is the right one, given the transaction next door confirmed this. By dividing the house price by the number of square feet of that property, we obtain a ratio. In the context of company valuation, these ratios are called multiples. Why are multiples so popular among investment bankers and investors? First, they are easy to apply when you need a very rough approximation of value. If a banker is specialized in an industry and expects that companies in that industry trade at 11 times price earnings, they can readily apply this ratio to a company with net income of $100 million. And we'll expect to see a market price near $1.1 billion. Lightning speed. At the same time, we should point out that sophisticated investors perform multiples analysis with much more caution and take their time. There's a great deal of detail and thought that can be included in a thorough multiples valuation. In most instances, we don't want to use multiples in isolation. Rather, we want to use them to triangulate DCF results. Once we have carried out a proper DCF analysis, we can use multiples as an ideal second proof that verifies the credibility of our DCF results. And finally, multiples incorporate market sentiment. In the hypothesis that markets are efficient, this becomes of critical importance when valuing an asset. The three most popular types of valuation multiples are the ones based on earnings, sales, and industry indicators. Among them, there is a clear pecking order. Earnings multiples should be the instrument of choice for analysts. They allow you to compare firms based on their ability to generate positive cash flows, which fundamentally is the one thing investors are interested in at the end of the day. Popular examples of earnings multiples are price per earnings, probably the best-known valuation multiple, and enterprise value over EBITDA or EBITDA. There is an important difference between the two multiples, PE and EV over EBITDA, and we will illustrate it with a complete example a bit later on. Unfortunately, in certain situations, we can't use multiples based on earnings. This happens when a firm hasn't reached profitability, or when it has experienced very volatile bottom-line results in recent financial periods. In that case, sales are the next best indicator of value, especially if the companies we compare the businesses with have a similar growth potential in the long term. Of course, the obvious disadvantage of revenue multiples is that they do not take into account profitability. Thus, we can have two companies that generate the same volume of business, one of them much more efficient than the other in terms of costs, and hence more profitable. Nevertheless, the two firms will be valued equally using a sales multiple. Again, the two most common sales multiples are price to sales and enterprise value to sales. And what if the company you want to value doesn't have any sales at all? This is when multiples based on industry indicators come as a last resort. At the time of the dot-com bubble, plenty of M&A deals were struck, and the underlying businesses didn't have any sales, let alone profits. One of the few criteria that could be used to assess these companies was website users. So, in this scenario, the analyst would have to form a multiple that measures value against web traffic or user registrations, for example. Naturally, the outcome of this type of valuation exercise is highly speculative. At the time of the valuation, it is very much unknown what would be the lifetime value of website users and how this would translate into positive cash flows for the company. Another example of an industry-specific valuation multiple is enterprise value over units of production in the oil and gas industry. A given plant's barrels of oil output per day can provide a relative measure of value to people operating in the industry. When we talk about valuation multiples, it is important to distinguish between trading and transaction multiples. Trading multiples uses the stock prices of comparable companies observed in the market for publicly traded entities. In this case, you use the current market price of a firm listed on the stock exchange to calculate the denominator of the multiple. The most famous trading multiple is price earnings, where price is the market cap at a given time of the entity under consideration. Let's say we want to calculate Meta's PE ratio. If their latest market cap is equal to $1 trillion and Facebook's, Meta's net profit for the last fiscal year is $100 billion, then we can say that Meta has a price-earnings multiple of 10. Trading multiples have an important advantage. They are easy to update and represent the market's most recent view, a critical factor in a dynamic environment. Transaction multiples, on the other hand, are the ones based on prices paid in previous acquisitions. A transaction multiple looks at an M&A deal of comparable companies and uses the purchase price to arrive at a valuation. A popular example of a transaction multiple is price paid at acquisition divided by EBITDA. Please be aware that transaction multiples should be applied with caution. Theoretically, they are higher than trading multiples because they incorporate an acquisition premium, the higher price paid by acquirers to gain control. Usually, acquirers will pay more than a firm's actual standalone value. we must remember that transaction multiples carry a control premium. The information about acquisition premiums can be very useful in certain situations. A firm that is about to acquire another company wants to have an idea about the acquisition premium needed to purchase majority control in the target entity. Another possible drawback of transaction multiples is that they are not always up to date. In some industries, it is very difficult to find transactions of comparable companies that have occurred within the last 6 or 12 months. Even in 12 months' time, marketplace circumstances can change significantly. When possible, the two types of multiples are used together. Trading multiples are current and up to date, while transaction multiples indicate the average acquisition premium expected by sellers. We said that multiples valuation comes across as easy and fast. Of course, it can be. One can calculate price earnings with lightning speed. However, the price that you pay for rough estimates is precision. The more time a sophisticated investor spends working on a multiples valuation, the more details will be reflected in their analysis, and hopefully this should lead them closer to the actual value of the asset under consideration. In this lesson, we'll discuss a few principles you should always bear in mind when working with multiples. First, try to value conglomerate companies and firms that have multiple businesses as sum of the parts. Truth be told, not all types of earnings and revenues are created equal. Initially, this might sound a bit counterintuitive, but there is a logical explanation that makes sense. Several years ago, Adobe transitioned to a subscription-type business. This was a very smart business decision because management sensed that customer lifetime value can be increased by bundling products into a recurring subscription, charging clients a lower amount compared to a one-off purchase, but more frequently. Over time, subscription revenues proved to be more valuable compared to one-off revenues because they tend to recur with much greater frequency and are easier to predict. At the same time, Adobe continued to sell some of its products with the traditional one-off sales model, according to which the client does not have to make recurrent payment. In this context, we can say subscription earnings and earnings from one-off sales aren't equal and should be valued with a different multiple. A very rough example would be 2, 3, or 4 times revenue for one-off sales and a much higher multiple of 8, 9, 10, or even more for subscription revenue. This is an example of a situation when it wouldn't be precise to use the same earnings or revenue multiple for the entire business of a company. Here's another example. A very large company that does very different types of business. Think of Tesla. They have their automotive business, which commands one type of margins, volume of sales, and growth perspectives. In addition, Tesla also has the solar roof, solar panel business. This is obviously very different compared to the automotive division. Without going into particulars, one might expect to see a higher multiple for earnings on automotive, where the company has some strong competitive advantages, and a lower one for the solar business, where there is plenty of competition and brand loyalty isn't as important. Very well. The second principle I want to share is regarding the use of price per earnings. This is a multiple that is very quick to calculate and often discussed in mainstream media, but at the same time, PE incorporates a major caveat. It gets distorted by a company's capital structure. A highly levered firm will have lower earnings and thus could appear to command a higher price-earnings multiple compared to its peer group, while generating an identical free cash flow. In our next lesson, we'll illustrate the difference between price earnings and EV/EBITDA in practice. Of course, this doesn't mean that price earnings is useless. It can be great for a very quick reference of how the market values a given business. But at the same time, whenever we prepare a more detailed analysis, we should use a multiple that is neutral from a capital structure perspective. Third principle, we should not forget to adjust for non-operating revenue, expenses, assets, and liabilities. But which items can be classified as non-operating? Whenever a type of revenue or expense cannot be characterized as part of a company's core business, then these items should be considered non-operating. If EBITDA, or net income if you use price earnings, includes non-operational or one-off income or expenses, we have to dig deep to exclude these items. The same is valid for non-operating assets and liabilities. The last point I want to address is the importance of peer group selection. This is one of the most challenging and trickier aspects when it comes to multiples valuation. If you value Tesla with a multiple derived from an analysis on Fiat, Ford, and Renault, you will make the conclusion that Tesla should be worth as much as Fiat, Ford, and Renault. Fundamentally, when you select comparable companies, you need to find businesses that have similar growth perspectives, financial performance, products, target markets, and strategic positioning. Extensive research and careful thought is required to assess each of these aspects. This is another reason why a proper and detailed multiples valuation doesn't necessarily require less time compared to DCF modeling. Selecting several companies that compare well with businesses you want to value will have a direct impact on the quality of your work. Each of the principles we discussed in this lesson brings more complexity to multiples valuation. There is a clear trade-off between theoretical correctness and precision on one side and the time an analyst needs to invest in the valuation process. The fine balance is a judgment call that needs to be made depending on the particular situation you are in. However, going forward, even if you neglect some of these principles, you will be aware that you have made some rough estimates that require additional attention when you have more time at your disposal. Price per earnings is the best known valuation multiple. It is very easy to calculate, and most financial data providers include it in the market summary one-pager they provide as soon as you look up a given stock. On the other hand, enterprise value to EBITDA, EBIT or EBITDA, depending on which variation of this multiple you want to use, is a bit more difficult to calculate and is subject to more interpretation on the part of the analyst performing the valuation. However, it has the advantage of being a multiple that is not distorted by capital structure. This is a very important issue which needs to be grasped fully to appreciate its seriousness. Let's illustrate it with a simple and easy-to-understand example. We have two companies that operate in the same industry, A and B. They have an identical growth perspective and compete in the same target market. For each of the two businesses, we have a P&L and a balance sheet, which would allow us to compute the respective price earnings and EV over EBITDA multiples. Very well. But before we dive into calculations, let's take a look at profit and loss figures of both firms. One can immediately notice that for an equal volume of business, annual revenue of 1,000, Company A is able to generate a net income of 40, while Company B achieved a bottom line result of 120. The reason for this? Company A wasn't as efficient in its operations? It doesn't appear that way. The two firms had equal gross profit and EBITDA. The only difference is the amount of interest expenses Company A paid. If you take a look at their balance sheet, you will see a 3-to-1 difference in terms of debt, 3,000 versus 1,000. So, naturally, Company A had to pay higher interest expenses and achieved a lower net income. There isn't any other difference between the P&Ls of the two firms. The rest of the balance sheet items are almost identical too. The same amount of current and long-term assets and an identical figure for short-term liabilities. The amount of leverage with which the two firms were financed is the only difference in our hypothetical example. Very well, let's go ahead and compute price to earnings. We already have the necessary data in the P&L and balance sheet, equity and net income. Price earnings is equal to equity, in this case we assume equity is equal to the market cap of the firm, divided by net income. We obtain that Company A's PE multiple is 12.5, while Company B has a PE multiple of 20.8. It looks like Company A is cheaper in terms of price to earnings. To buy the firm's shares, we have to pay only 12.5 times its annual earnings compared to 20.8 for Company B. The next thing we want to do is calculate the enterprise value over EBITDA multiple. We already have EBITDA, and that's great. However, enterprise value is a metric that isn't immediately available in the P&L and balance sheet. We have to calculate it. Enterprise value is equal to a firm's market value of equity plus the market value of debt plus debt-like items, like unfunded pension liabilities and others, minus cash and minus non-operating assets, the assets that did not contribute for the formation of EBITDA. In our example, we'll make a series of assumptions that make EV's calculation much easier. First, the only debt the companies have is the one listed as debt in the balance sheet. Second, the equity listed on the balance sheet corresponds to the market value of equity for both firms. And third, both firms do not have any cash or non-operating assets that need to be subtracted. So, by summing debt and equity, we obtain an equal enterprise value of $3,500 for both Company A and Company B. And given that they have the same EBITDA figure, the two companies have an equal EV over EBITDA multiple. This proves that the EV over EBITDA multiple does not get distorted when it comes to capital structure, while price per earnings is impacted by financing decisions. Of course, when valuing a business, we're very much interested in its enterprise value because capital structure decisions can be reversed rather quickly. Investors can repay a company's debt overnight in some situations. And what counts in the long term is the ability to generate operating cash flows for a given level of capital invested, be it debt or equity. In this part of the course, we will provide a practical example of multiples valuation. As discussed earlier, using this technique isn't necessarily quicker than building a complete discounted cash flow model. In fact, in some instances, if done properly and with great precision, multiples require more time and can be harder to compute. There is a clear trade-off between precision and time to be invested. Let's define a few approaches one can have considering the time versus degree of sophistication trade-off. Here's a chart depicting degree of sophistication on one axis and time on the other. One option is to use multiples like price earnings, which can be calculated instantaneously. When you do that, the multiple serves as some sort of rough proxy. But we need to read it with a pinch of salt. By now, we know the price earnings can be impacted by capital structure, and thus provide a distorted view. Nevertheless, the obvious advantage of PE is that it gives us a readily available benchmark, which can be used to eyeball how a firm trades on the market. When we're not that pressured, we can use a more sophisticated type of multiple, such as EV/EBITDA. To do this, however, we'll need to obtain the financial statements of all companies in the peers list and spend a bit more time. Balance sheet and income statement data is necessary to calculate enterprise value and EBITDA. If we don't have the time to dig deeper and adjust EBITDA for one-off and non-operating items, then this option would rank as a bit more sophisticated than PE. It would definitely take more time, but not too much, as obtaining enterprise value and EBITDA without making adjustments is a rather straightforward task. And finally, the third approach would be the one that ranks as the most sophisticated, but it is very time-consuming too. A proper multiples valuation requires us to dig deeper and pay attention to the notes to financial statements, in which we can find additional detail and information. The goal of this exercise is to isolate non-operating and one-off items and clean EBITDA to obtain an adjusted EBITDA. And then, if we have cleaned certain types of income from EBITDA, we shouldn't forget to exclude the assets or liabilities related to these types of income from the calculation of enterprise value. For example, if an analyst performing a valuation makes the decision to remove rental income from EBITDA, then they have to subtract the non-operating real estate generating the rental income. Sometimes, even if we have the necessary time, we are not going to be able to work with this level of detail because companies provide limited or vague information in their financial reports. In such situations, we should be practical and perform a valuation which is as precise as possible. Adjust EV and EBITDA to the best of our abilities, but at the same time, be aware of the limitations of our work due to the quality of reporting data. The practical example we will solve together is about the valuation of Volkswagen. The target date at which the valuation was carried is the 3rd of May of 2021. By that time, all companies in the peer list had published their annual statements for 2020. We used market price data relating to the 3rd of May 2021 to determine each firm's market cap.